Alright, this is another episode of me sticking my nose into the charts every single day until I discover a trade model that makes me millions and millions of dollars. And recently, my eyes have been absolutely opened studying the 2024 mentorship. So, a little bit of background. I dropped supply and demand around 2 months ago, began studying ICT, but I was absolutely clueless, tried looking for shortcuts, tried finding the fast way to learn how to do it, and it only led to more confusion and more anxiety. But then, all of a sudden, he started the 2024 mentorship. So I was like, oh shit, let me just do this. And ever since then, my understanding of the market and how to read price action has just been going through the roof. It's been crazy. So it's been one hell of a journey. I'm glad I dropped supply and demand because now I see the truth. Now I see how price actually books and how it moves and why it moves and how it's moving. I see everything. I see it now. It's awesome. And so now I'm just following the process that he's outlined for his son in the 2024 mentorship, and I'm seeing exponential progress in my growth. It's crazy. This is my first week of reading Price Action Live. Today was Friday. It solidified the end of my first week reading Price Action Live, and I've seen so much progress just from 4 days ago back on Monday. It's unreal. It's crazy. I'm progressing at such a fast rate because I have a process that I can follow now, and all I do is work all day, every day. So my growth rate right now is insane. It's crazy, and it's awesome, and it's fun. It's exciting. So this is what I'm doing at the moment. I'm not taking any live trades. I'm just recording observations. I'm just looking at price action and thinking, when would I hypothetically place a trade? When would I hypothetically enter the market? So these are all hypothetical scenarios. I'm not actually pushing any buttons. I'm not even demo trading. And I'm just recording, okay, I would get short here, or I would get long here. And that's it. It's all hypothetical. And then I'm just tracking these metrics to build a baseline for my trade model and a baseline for my skill set. How well can I read price action? So I'm simply tracking, was it right or wrong? What time did I discover the setup? How long it took to deliver to my objective or stop me out? How fast did it take to begin moving in my favor or stop me out and move against me? How far did it move in my favor and how far did it move against me? So you can see that my very first observation was not the best. It took 1 minute to stop me out, moved 2 handles with me and 2 handles against me, and I stopped out. Now compare that to this, what I caught today. Caught a solid move today. Look at that. 229 handles in my favor. So you can see, just from looking at my first week of doing this, there's a lot of progression. My first observation, I got stopped out in a minute. My last observation this week, it moved 229 handles in my favor. And it's awesome. It's a great feeling. It's a great feeling knowing where the market's likely to go next and then just seeing that unfold. I don't even know how to put it into words how that feels, but it's fucking awesome. And I'm also recording missed observations that I saw develop in real time, but I didn't hypothetically pull the trigger on because, some emotional aspect. So I'm not even taking any trades with real money or even demo trading, and I still have a little bit of an emotional aspect. And two flaws that I found out about myself, well, the major flaw in my character that is causing all these psychological issues is that I don't like being wrong. And I don't like when things don't go my way. I hate that shit. And this week revealed that about me. And it's very clear and obvious because whenever I stop out on a trade, I get this ick inside me. And I hate that feeling. I hate being wrong. And whenever I'm in a hypothetical trade scenario and it begins to retrace and move against me, I get an ick as well. And I hate that feeling. And I don't like it. So I hate when things aren't going as I anticipated them to, and I hate when I'm wrong. So those are two things that this week has revealed about my character. And those are just some things to work on. So anytime that I feel that emotion inside me, when I get that ick, that's an indication that I'm feeling that, right? And so I just journal the shit out of it and do a lot of positive self-talk. No negative self-talk. You don't want to, that's just toxic. It doesn't do anything good for you. So I just coach myself and I just journal it. I journal everything that I'm feeling. I don't give any energy to that negative emotion. I don't allow myself to amplify it because you have the ability to feel that emotion and either choose to amplify every bit of it and make it even stronger and more powerful and more destructive, just making you do all kinds of dumb shit like overtrading, revenge trading. Or you can be mindful of it, know that it's there, and just let it go, journal it, displace its energy, and get it out. And so a good coping mechanism that I've found that helps me deal with emotions like that is just simply journaling the shit out of it until it's gone, until you don't feel it anymore. And then I'm good. So, not only am I learning my trade model this entire week, but I'm also learning a lot about my character and how I react to certain situations. And I'm not putting any money on the line doing this. So it's genius. This process is absolutely genius, and I love it. And then I'm just tracking how many observations I got right in the day and how many I got wrong. And then here's how I ended this week. I actually ended up getting 2 wrong today. So let me update that. So I got 9 observations right and 10 observations wrong. And I am being completely honest with myself. I'm being straight up. If I get it wrong, I get it wrong. I'm not going to think, oh, I got it wrong, but maybe I won't record it. No. I'm being straight up with myself, and I'm being honest. This is where I currently stand. This is my skill set. This is a good measure of my ability to read price. So if you look at this statistic, my win rate is a little under 50%, which is not bad for my first week ever reading price action. I'm actually very satisfied with that. And now I'm going to go in and record some key observations that I made today. I don't know if I'll go over all of them, but I know I forgot to put the metrics into this one. I need to update that. But this one was a key lesson. I'll probably just go over these 2 right here. Maybe even the first one I'll just go over real quick. But so the first trade scenario that I saw today was pretty simple. This is me just simply studying price action. This is not a hypothetical trade that I would take if I had live money on the line, because this is just me studying how the market moves. So going to the 8 o'clock hour, I have to look, where is the market smooth? Because where it's smooth, that's where it's going to go. And where it's jagged, that's where it's going to move away from. And at the start, at the top of every hour, you anticipate a fake move, a fake price swing, right? So you can see that from the 8 o'clock to 9 o'clock hour, initially we trade lower, then we trade higher. This is building the low of that hourly candle. So it's an hourly power of 3, if you think about it. But I caught this little sell scenario right here. I observed it. Simply because the market was smooth down here. We have these relative equal lows, so there's going to be sell stops below there. And the first thing that we do at the 8 o'clock hour is run the 7 o'clock high. So this high is taken out, buy stops taken out of the marketplace, and then I begin seeing this. So one of the trade models that I've learned I like to look for, I need to do that, is number 1, a run liquidity. Take some liquidity out of the marketplace. And then number 2, we inverse a fair value gap on the left side of the curve, and then we have a fair value gap on the right side of the curve. So if I see those 3 things, as well as a change in the state of delivery, I know that I have a trade setup. This is also a breaker formation as well. So I see the run on buy stops. I see this large down close candle. I'm thinking institutional order flow entry drill maybe. So there's a potential short opportunity to take it short down here. So, I mean, the risk to reward in this trade, I think, was a 2-to-1 flat. But I'm just studying to see if price can deliver where I think it's going to go. This is not actually a trade that I would take. But had I taken this trade, the risk to reward on it is too flat. And it's only for 10 handles, right? So the range really isn't even there either. But I'm just studying price and observing where is it likely to go next, and it delivers. So there's this observation. And initially when I came into the market today, my draw on liquidity was lower. It was lower because look what we have in the overnight session, or in yesterday's session, the new day opening. So we have a new day opening gap inside of a new week opening gap. That is a strong draw on liquidity. Not only that, but look at these smooth lows left inside of that new day opening gap. That we are lacking sell side delivery on, or did we trade down there? Let me see. Oh, we did trade down there. Okay, never mind. We aren't lacking sell side delivery. We actually did kind of wipe this. But still, we have a lot of relative equal lows. We have a new week opening gap, a new day opening gap. So that is a very, very strong draw on liquidity. I saw that. first thing when I opened the charts, we had these very smooth London lows, so that was also a strong draw in liquidity for me, and it was very similar to what I saw on yesterday's price action, where I opened the charts and we have all these very clean, smooth lows, and underneath that it's going to be buy stops. The market wants to go where it's smooth because that's where liquidity is resting, and it's going to move away from where it's jagged. So it's literally the same thing that I saw yesterday. So I was thinking, okay, probably do that shit again. Pretty simple buys, as well as the new week opening, new day opening gap. So put those two together, and that was my buys for this day. I'll go over this hypothetical trade scenario that I got wrong, this observation that I got wrong, and why I got it wrong. Where was my liquidity? It was right here. Just gonna mark this level real quick. So my chart is very busy because I'm a novice. I'm still developing, so I need to have these levels on the chart to be mindful of them and to reference them. But initially I'm going to get to the point where I just keep them on a notepad and I keep them off my chart, so I'm not forcing my will on the chart. But right now, I kind of have to get an idea of how the algorithm refers back to these levels over and over and over again. But this is my liquidity. These clean, smooth, relative equal lows, right? Here's that 8 o'clock range low. It takes out this low, does not trade to this low. So what is this seen as? Support. And it's smooth, so the market's going to want to attack it. But at the 9:30 open, what I saw was here, we formed the high day, large down close candle, sell side imbalance not traded back into, indicates a sign of weakness if the market can't even reprice back up to it. So we reject the CE of the premium wick on a daily chart, or an inverse wick, or what was it? Yeah, it was an inverse wick, right? So the consequent encroachment of this wick right here, we reject that. So I marked that on my chart. Price could reference this level. And so at the open, after rejecting this and seeing this really weak action where we can't even reprice back to this imbalance, see large down close candle at the open, we have this short-lived rally, and we immediately leave an imbalance and an imbalance. So right at the bell, I'm thinking if we trade up into this imbalance right here, this first imbalance at 9:30, that's significant because it is the first imbalance left from 9:30 to 10 o'clock in the opening range. You want to extend that throughout your timeline. But I'm thinking price could trade up, refer to this imbalance, and then break down, trade lower, and touch the opening range gap. Because I know that there's a 70% probability that the market's going to refer back to consequent encroachment of the opening range gap, which is the difference between the settlement yesterday at 4:15 and the opening today at 9:30. So that's what I was thinking for this trade idea. I was thinking we come test this imbalance and then go reach for the opening range gap, but we never got down there, and I hypothetically stopped out on this trade. Now, what was a great indication that this setup was not going to work out? Well, number one, we dove into this pretty significant pool of buy side or sell side liquidity, right? And if we tap into a pool of sell side liquidity, what is the market likely to do next? Retrace, reverse, seek buy side above old highs, right? So if we tap into the pool of sell side liquidity, which is pretty significant right here, it's probably going to go seek some old highs, and I don't think it's too smart to get short right after the market taps into a pool of sell side. So, and on this bearish order block right here, or what I thought would be a bearish order block, it gets invalidated. I know it gets invalidated because price violates the rejection block. Once price crosses the rejection block, then that immediately invalidates this as a bearish order block, and I scratch the trade idea. So here is my hypothetical entry right here. So honestly, I stopped in a little bit of profit on this trade. Stop would probably be of consequent encroachment of that, and I'd be targeting this, right? So that's that trade idea. I'm thinking we come back, touch the sell side imbalance, and break down. But we don't do that. And instead, what would have been this bearish order block gets invalidated because price crosses the rejection block. So this is immediately invalidated as a bearish order block, and I scratched the trade. That's rules left in the 2024 mentorship that he talked about yesterday. So, and I got to see it play out reading price action live today, so that's great. So this is an example of when the market does not move in my favor. An example of when I would scratch a trade early. Perfect. I love when I get it wrong. Then I can go back in and learn what was a good indication as to why it went wrong. Why did it not play out? I get to study that and see. Well, number one, we just took out this sell side below old lows, and number two, this bearish order block was invalidated. So I'm protected on this trade if you think about it. I wouldn't even take a monetary loss. I would probably break even. Or even better, maybe a little bit to cover costs. And then this is where I caught this entire move, because throughout the entire session I was thinking lower because we had these clean lows in the London session. Not only that, we got these clean lows with a new week opening gap and a new day opening gap, and it's all just nestled in right here. It's all unbothered, untouched. If you look at what price has done the entire day, it's just simply one-sided. Where the fuck am I? Okay. It's just simply one-sided. All the money's been made on the long side of the market. And at the 9:30, at the 10 o'clock news driver, manual intervention steps in. They pump it higher, and I'm thinking, well, shit, this thing's getting really excited. It's getting really, really excited. They send this thing higher. So at this point, I'm kind of thinking, is this going to be a trend day? We've had a one-sided move in the London session. Could potentially be a trend day. I don't know what they want to do with this thing. I'm sidelined. I don't have a clean read on the market. But at the same time, I still got, my draw on liquidity is lower. So I think a big lesson that I've learned throughout this week is that no matter how far the market moves away from areas where price is smooth, it will always seek to attack them, because that happened yesterday and it happened today when it moved like how many handles away from these lows, but still ended up trading back down to them. 231 handles off those lows. So me as a novice, new to this, I'm thinking like, damn, those are pretty far away. Can it actually get back down there? Because I used to stare at the tape and read order flow and only watch the market on a tick by tick basis. I'd never watched a daily range develop or anything. So I'm completely new to this. And yeah, the daily range has the capability to reach back down into the London low. It can do that. And that's a paradigm shift for me, a big paradigm shift. It's just something that I'm not used to. It's a new idea. So yeah, even though there is distance between these levels, it can travel back down there. So, but this entire move up, we're just leaving smooth lows the entire time. Literally identical to yesterday's session. Okay, now what began to spark my interest in a short idea up here? Number one, well, not number one, basically the whole logic that framed this trade idea was this old volume imbalance on a daily chart. If we go back to the daily chart, here's that volume imbalance. Put quadrants on it. And if price can't reach into the consequent encroachment of the volume imbalance, what does that indicate? The market is weak. If it is weak, it will not be able to reach into consequent encroachment of that volume and imbalance. For any inefficiency, we want to see them stay open. If it's a sell side imbalance, we want to see the lower quadrant respected. We want to see price stay inside that lower quadrant. We don't even want to see it touch the upper quadrant. But if it does touch the upper quadrant, then we want to see it immediately reject price. So the fact that we are working around 0.25 of that lower quadrant of the volume imbalance on the daily chart, and we are rejecting it, that indicates weakness. So right here, this is where I have my first trade idea short, because we don't even trade up to 0.25 of that daily volume imbalance. So that indicates weakness in my eyes. When I see, where's my hypothetical entry on this? Oh, it was right here. Okay. So basically I saw the same thing over here. It just didn't work out. So I see this stop run, right? Buy side liquidity ran out of the marketplace. I see this imbalance gets inversed. Fuck. So now I want to see, do we have the capability to refer back to this inverse fair value gap and then send price lower, attacking these relative equal lows, these relative equal lows, consequent encroachment of the opening range gap, the sell side liquidity from the London session. I'm looking for all of that. So there's all these levels that we have not referred back to when the market is trading all the way up here. So that's what I was looking for at the time, because we failed to reach 0.25 of the daily volume imbalance. Begins to fade off of that, but it didn't happen. Market just ran right over top of this, and a good indication that this one was not going to play out was a lack of a significant reaction off of this sell side imbalance. So I'm seeing these large down close candles, a change in the state of delivery. When the market reprices back to the sell side imbalance, I want to see speed, magnitude, and distance off of that. I want to see an aggressive move off of that to go attack these relative equal lows and these relative equal lows, but we don't get that. Yes, we reject the upper quadrant. Yes, we stay in the lower quadrant here and here, but we just fail to move lower. There's no significant move lower with speed. It hangs around, consolidates, trades sideways. We also see that the new day opening gap is respected, and then boom, large up close candle completely wipes the imbalance, and then we see it act as an inverse fair value gap support price, and then we take out these relative equal highs, and that is when the sell scenario presents itself. What did I just do? Not that. Yo, come on. Okay, there we go. Technical difficulties. Alright, so this trade scenario did not work, and it is not until we see what? SMT divergence that the market begins to break down, right? It is not until we run these relative equal highs and touch 0.25, the daily volume imbalance, that we see a valid sell scenario. That just immediately works right away. No lag, no hesitation. It just goes, and it's seeing this play out live was fucking awesome. But clearly we have a crack in correlation. So this is really what kind of gave it away. This was the algorithm showing its hand, like, yo, you have a trade here. So in yesterday's price action, I watched this sell scenario develop in real time, but I did not make note of it because I tried a hypothetical sell scenario two times before, and stopped out on both, got it wrong on both times. And because I got it wrong twice, my ego was hurt a little bit, and I didn't note the third time, even though I saw everything that I needed to see. And SMT divergence. If I go back to yesterday's price action, there was two. This is yesterday's action, right? Relative to hello. Right? And that was right at the 9:45 news driver. So another crucial lesson that I've learned this week is if I get an SMT divergence on the 15-minute time frame, that is visible on the 15-minute time frame, because if I put this up over here, this is on the 15-minute. Whoops. I need to lock those. Delete this. So if I see an SMT divergence that is visible on the 15-minute time frame, oh wow, we're coming back up, reaching into that high. Then that is when it is likely that the market's going to turn the other way, and I can look for a sell scenario. Combine that with the logic that price is failing to breach 0.25 of the daily volume imbalance, and I have a change in the state of delivery, and an inverse fair value gap, and a sell side imbalance. It's just everything comes together. It's everything that I need to see. And the same thing happens yesterday. See, if I get an SMT divergence that is visible on the 15-minute time frame, I have a pretty solid trade idea. So that's that. And now here's where I got my hypothetical short entry. Oh, another piece of logic that I use for this trade is that this week we have Jackson Hole Symposium. And in the week of Jackson Hole Symposium, price action is overlapping. It goes back and forth. It's railroad track action. It just goes up, down, up, down, up, down. We can expect wild, impulsive price swings in both directions. And if I look at the price action throughout this entire week, I can see that, yeah, that's what's been going on this entire week. We've had large moves up and then followed by an immediate large move down, and large move up, and large move down, and large move up. Go to this day, what do we see? Large move up, large move down, large move up, move down. And this was kind of one-sided. So Monday and Thursday were one-sided. But I was also thinking in the moment, okay, it's Jackson Hole Symposium. I know that even though we have this huge range, trading higher, 187 handle run, I know that it's Jackson Hole Symposium, and we can probably see this entire range get overlapped. So that was what I was thinking in the moment as well. Another piece of logic to support this trade idea. And so we run these relative equal highs, and what do I see? A change in the state of delivery. Here's that highest up close candle running out buy side liquidity, so that's a high probability bearish order block. We tap the open price, reject it, large down close candle that leaves a sell side imbalance. Not only that, but we also invert this buy side imbalance. So all these factors coming together, converging in one location with the narrative that the market is weak because we can't breach 025 of the daily volume imbalance. We just ran out these buy stops at the high day, and there's an SMT cracking correlation, and we have all these relative equal lows resting below the marketplace, and we have yet to touch CE of the opening range gap, and we have a new day opening gap inside it in week, new week opening gap with relative equal lows inside of that. Everything just came together, and look how we just perfectly boop right into the consequent encroachment. We fail to reach the consequent encroachment of this inversion wick, so that is also another indication of weakness. Look how the bodies respect consequent encroachment of the inversion fair value gap, and the consequent encroachment of the inversion fair value gap aligns with the new day opening gap. Look how the bodies of the candle stay inside of the new day opening gap once we are below it and do not violate it. Wicks are allowed to do the damage and color outside the lines because this is just referring to consequent encroachment of the sell side imbalance, and then boom, rolls over. We leave this sell side imbalance open. What does that indicate? Weakness. If the market cannot even reprice higher to a sell side imbalance, that shows me that it's weak. We leave this volume imbalance open. We leave this sell side imbalance open. Come down, trade, prime these lows, reaching this general area, so retail is going to see it as support when we get this large up close candle. That's just priming these lows, making retail think it's support, engineering more sell side liquidity. But this is just reaching back up into this volume imbalance, and look how the bodies beautifully respect it. That is perfect, absolutely perfect. They even respect the consequent encroachment of it. That doesn't get any better than that. So you have that. Wicks are allowed to color outside the line and do the damage. I wonder if we respect consequent encroachment of this discount wick, inversion wick. Not really, but we respect 025 or 075. We also invert this. And then we just absolutely roll over. And we clean out these lows, clean out these lows. almost fill in the opening range gap, and we refer right back to the new week opening gap high from this week. And then eventually we do close it in. Look at the bodies. That's crazy. And then we see our retracement. Pretty crazy. So it wasn't until I saw that SMT divergence at the highs that a sell scenario was in play. So initially I got stopped out, which is okay. Came back, ran those relative equal highs, and then cracking correlation, change in the state of delivery, bearish order block, sell side imbalance, inverse fair value gap, fail to reach CE of inversion wick. Everything comes together. Everything that I need to see to take a trade. So textbook setup. Exactly what I want to see. So, and if you think about it, what is this? A breaker block. And we reach up into the breaker block, right? So yeah, breaker formation. This is also a breaker formation. Because we come back and tap the breaker block and then we just trade lower, roll over, right? So even if you miss all this move, this breaker block is still in play. Come back, tap it, tap consequent encroachment of this sell side imbalance, and roll over. And then we go and attack those lows. So we come just shy of these lows and we stop. What does that do? It makes retail think, oh, this area is support. Let's get long. Let's put a stop loss below this low. Now there's even more sell side liquidity below that low. So what does the market want to do? Attack it. After what? It references the breaker block and sell side imbalance and new day opening gap. So that was it. A lot of lessons learned today. Number one, I learned that I have to be comfortable with retracements against my open position because I don't like being wrong and I don't like when things aren't going my way. So that's something that I got to work with. Number two, I learned that no matter the range, the market can always refer back to where it is smooth because that's where it wants to go. Ultimately, it's going to move away from where it's jagged and attack where it's smooth. Number three, an SMT divergence that is visible on the 15-minute time frame is key. If I see that, it is likely that price is going to get sent the other way. Number four, do I have 4 lessons from today? Let's think. Let me see. I got this thing. This thing is a lifesaver. Let me check this real quick. Because I'm journaling everything, literally everything, every fluctuation in price. What are my thoughts? What am I thinking? What's going through my mind? Every little emotion that I feel. What am I thinking? What's going through my mind? And it all gets journaled and it all gets stored in this thing right here. So this thing is a lifesaver if you are a trader. I would definitely get this. It's probably the best $600 that I ever spent. Especially for me because I'm like things organized. Everything has to be organized. And it has to be the way that I want it as well. So, trading journal. And I know exactly what I was thinking throughout the entire day because I have it all written down in this thing. Lessons learned. So I said, be comfortable with retracements. And yeah, no matter how far price may seem, it can always flip for the reason to attack where price is smooth. Where it is smooth, it's going. Look for a cracking correlation on the 15-minute time frame. If it is visible on the 15-minute time frame, it will likely send price the other way. Oh yeah, I must link my analysis to daily PD arrays. Note every single one in close proximity and put quadrants on them. Because the whole reason that the market reversed here, well, this analysis was linked to something on the daily time frame. So that is why the market sold off here, because we failed to reach consequent encroachment at the daily volume imbalance, and that suggests weakness. And then the final thing that I learned today, my current models are a breaker formation with a change in the state of delivery / order block and an inverse fair value gap / fair value gap. And a run on liquidity with an inverse fair value gap, a change in the state of delivery / order block, and a fair value gap. So that's basically it. And combine that with the SMT visible on a 15-minute time frame, and that is a powerful setup. So I've learned that. And today alone. So I'm learning so much every single day, and it's awesome. It's incredible. It's fun. It's exciting. And I'm absolutely loving the process without even having to place any trades at all. So it's Win-win scenario. I'm doing great. I'm having fun doing it, and I'm just recording the journey. And eventually, your boy gonna blow up. So, that's it for today. And tomorrow, I'll do a weekly review and go over my biggest lessons and the best setups and the worst setups and why they didn't work and the best setups and why they did work and all that and psychology and emotions and whatnot and all that. So, goodbye.